Welcome to the Restaurant Boiler Room, Season 6, Episode 5. I'm your host, Rick Ormsby, Managing Director at Unbridled Capital. Today in the Boiler Room, our Unbridled team will be discussing the state of the franchise M&A market as of the end of Q2 of 2024. Topics include deal flow, improving your valuation, supply and demand of deals for the remainder of the year, where are the private equity buyers, and considerations when trying to close a deal in this difficult environment. The Restaurant Boiler Room is a one-stop shop for multi-million-dollar merger and acquisition activity and financial complexities affecting the franchise industry. We talk money, deals, valuations, and risk, delivered to the front door of franchisees, private equity firms, family offices, large investors, and franchisors on a monthly basis. Feel free to find our content at Unbridled Capital's website at www.unbridledcapital.com. Now, let's enter the boiler room.
Here we are at 1 o'clock, and it's just past one after. So I'll go ahead and kick us off, and I want to thank everybody for being here. Whether you're going to be listening on podcast or webinar, we've kind of dialed these things back a little bit. The webinars this year, it's kind of the deal flow has been a little bit less. Being observant of the information coming forward, not being as fluid as it has been in prior years because of the lower deal flow. But if you're listening on podcast, I want to say welcome to the Restaurant Boiler Room, people. Thank you for listening, being faithful to listen along. And if you're on webinar too, we're thankful that you're here. Today's topic is really to do kind of a mid-year discussion of what the M&A market looks like. We're going to dig into it with about 15 questions that we kind of have written out here. We're just going to answer them in 3 and 4 minute blasts. Hopefully you're going to find that interesting. And we're trying to keep it pretty dialed in, narrow, and focused on franchise, investment banking, M&A, deal flow, and valuations. So there's going to be a lot of that kind of more hardcore content that I know you guys appreciate. A couple of comments as we get going. I would say if you have any questions or want to ask any questions along the way, just buzz them up on the bottom of the Zoom screen here, and we'll try to answer them. Derek, maybe you keep up with it. And then afterwards, we'll send out a webinar replay to everyone who's signed up too. So you'll be able to get that to your inbox. And if you have any questions about deal flow or you want to talk about valuations, call us, email us, whatever, or go to our webpage at unbridledcapital.com. Okay, as we get started for 2024 mid-year, the first thing I'm going to say is I'm going to make a couple of quick comments because we're going to talk about a lot. But as I was just kind of penciling, what's the highlight of today? I would say a couple of things you would want to take away. One is we're going to talk about there being not a lot of businesses for sale right now. It is shockingly slow. It feels like a desert in a way with new deal flow. And so low amounts of deal flow, almost record low amounts of deal flow at the very moment. So that would be one thing to take away. A second thing to take away, from today would be reasonable prices for buyers and sellers coming back towards more of a 10-year norm, been down a little bit from the peak. But if you have a really good business to sell, you're going to get a really good price right now because there isn't anything really good on the market. So good businesses with good AUVs and strong EBITDA are selling quickly. Otherwise, there's not a lot of deal flow there. And then the third thing I would say is we're going to talk about a store closure example where we started off in a business that we were putting up for sale with, let's call it, just to disguise it a little bit, 100 units. And then we couldn't sell it or only found one offer. We went back to the market months later with 80 units, 20 of them closed, and all of a sudden there's 6 offers. So that's a learning. We're going to talk a little bit about that. And then lastly, I would talk about, presidential election and politics with tax cuts. So we'll expand a little bit about that and how that may be a factor with capital gains and ordinary income taxes possibly set to raise depending on what happens in the elections. With that all being said, Derek and Peter, I will let you guys answer the first question. And it is, give us a commentary, please, or what is your commentary on the current supply and demand for buying and selling franchise businesses right now? Go for it. What do you guys think?
I'd say, you kind of hit it at the very beginning. Current deal flow as we speak over the past 2 to 3 months, very low, but kind of on, for the rest of the year, it's going to be kind of on par, probably might even be a little bit higher or right at the same as it has been years past. Just right now, as you mentioned, the very first comment, extremely low deal flow going on. The ones that we have marketed, buyers have been a little bit more careful and a little less aggressive when offering more packages, but it's kind of hard to argue with that when borrowing costs are, where they are right now. You mentioned a while ago, premium businesses, very attractive. Those are still the case, but we're not really dealing with just one brand individually. We're dealing in several different brands out of the ones that we have marketed. So, it's just It's slow right now, but for premium business, it's going to bring a lot of demand. And, depending on pricing expectations, some of the more less the desirable ones will still bring in offers as well.
I think, we probably have 10 engagements right now, active engagements across 7 brands, which has kind of been, given where our business is probably, 20 or 30% lower than normal minimally. So what do you say to that question, Derek, about buying demand, supply and demand?
There's a lot of people that want to sell today. There's just not a ton of people with expectations that are in line with the market. I've told people recently, we're halfway through the year. I think we've turned down over 30 deals this year. And when I say turned down that many deals, just expectations weren't in line. If we're 15+% off in terms of our expectation on what the market will give and what a seller wants, we'll generally just tell them we can't take your assignment unless your expectations are more in line with market. We take assignments, then we're going to get the best market price for the client. We hope to find that needle in a haystack, and get a crazy good price. But we won't sign on a client who's only looking for that needle in a haystack. Time value of money for us doesn't work out that way. So there are a lot of people that want to sell, but there are a lot of people that have expectations that are in line with the market, and that's okay. Everyone has a reason to sell. I'm not holding that against anybody, just not the right time for a lot of people selling. In terms of buyers, there are buyers out there. It's not like 2021 or late 2020 by any means. You have buyers that want to take on premium businesses, like Peter said. When it comes down to just average businesses, they're just tougher to sell, tougher to finance. Buyers see them as more risky in terms of any potential downturn. And you see the multiples in those businesses just really falling. During COVID, you could sell anything at premium multiples. Now, when you get that average business and an average tier 1, tier 2 brand, the multiples just aren't. There's a bigger dichotomy between the premium and the average deals in terms of the multiple. And it's tough for a lot of franchisees to really hear that, then accept it and go to market. So unfortunately, there's not a lot of supply. There's still demand. It's not premium pricing demand, but it's just...
Yeah, and I hope that answers that question that we had just came in. I think I would agree with Derek here. Like demand, I would say, which is buyers, and supply is the sellers. In this case, I would say if 10 is incredibly high demand, and 0 is low demand, we're at a 4 from a demand standpoint. And then from supply, being the amount of people who are selling businesses, 10's a lot, 0's none. We're at a 0 to 1, maybe 0.5. Yeah. So if that kind of gives you, for you economists out there, it gives you a little bit of a feel from our perspective of kind of what the market looks like. So the issue is that the pipe of sellers that we're running through here, the pipe is so constricted. That's the reason why there's no deals that are happening. There's more buyers than there are sellers. There's not a lot of buyers as there were 3 years ago. What about...
Keep in mind, like I said, we could have thrown 30 more deals on the market. Maybe we'd have closed 5 or 6 of them. That's not our...
Just not our model. Yeah, just not our model.
The deals you see from us, we've hopefully vetted that client well enough to know that their expectations are still top of market, but market, and not 20% higher than market. Yeah. So that's why you're not seeing a lot of deal flow.
Yeah, for sure. Well, let me, thanks for the clarification. Question number 2, we'll go a little faster through the rest of these. Why aren't sellers selling right now? We kind of talked about this a little bit. I'll throw some comments in here about just 1 or 2. They're thinking that the future will be better than the present. But the question that we would ask you guys, and maybe opine on this if you like to, is what do you think? I mean, if you're operating a franchise business now, how do you think the environment will be a year, 2 years, 3 years from now? Knowing that when you sell a business, you're going to sell it most readily on the trailing 12-month financial statement in arrears from the most recent month, looking backwards 12 months. So, I mean, is the future going to be better than the present? I mean, I think on this call here, I'm going to characterize us all. I'm probably neutral to slightly negative. Derek is doom and gloom. Peter, I would say, is probably neutral. Would that be kind of fair?
Yeah, in the middle.
So, that psychology, that goes behind what you think about your future and your family, that has a lot to play with how you think about the future of your restaurant company too. But why aren't sellers selling right now? That's one reason. What's a couple other reasons real quick?
And trans are kind of down across the board. You've got some special brands that are still doing really well, but across the board, EBITDA is down a little bit. Trans are down usually even more. sellers don't want to sell on bad numbers. But like Rick said, it's tough to have a perfect trailing 12 P&L. And when you get that perfect trailing 12 P&L, then you have to do a 6-month transaction where your rollovers might start rolling over good periods. And then you're going to get a retrade during the deal. Not faulting a buyer for that. I'm just saying what it is. You've got a lot of people that believe, and we're not going to get political on this call one way or the other. You got a lot of people think that Trump will get elected, and he'll fix all the problems. I kind of pose the question back to people, what is he exactly going to fix in the near term? So again, not planning on getting political at all. It's more of a question. You might agree with it.
Said a different way, do you expect that your P&L is going to just go bonkers in the positive direction because of one political candidate or another? Yeah, and I think all three of us would say that probably is overblown. Don't put too much weight on that. You know what I mean? We hear that a lot from clients, and I think it's maybe a little bit overblown would be the comment. And then real quickly, let's jump to the next one. But lending market for buyers and sellers is not very good right now. You have a lot of banks that are desperate to make loans, right? Because you have all these people that we know that are in the commercial loan business, all big names, and they're not doing any loans, and they maybe closed one loan in the last 12 months. But then they're because of their deposit situation or because of the constricting credit, departments and the risk that they're allowing, they won't close deals. So if you just ask around at some of these bankers, you're going to find that no one's been closing deals. It's pretty dry. It's pretty hard to get money. We're hearing some alternate lender lending at well over 10% interest rate right now in a kind of a brand that's hard to get financing for. So interest rates are high as well. But what about buyers? What do you think about buyers? We talked about sellers. It's a valuation issue for sellers. The values are probably a quarter to a half a turn higher than they were 10, 8, 7, 6 years ago, but they're probably a time and a half or at least one turn lower than what they were in 2021, right? So so that creates time for a seller to have to get real about what their valuation will be, or they say, I'm going to wait until it maybe migrates back upwards if it ever does. But what about the buyers? Why aren't they buying right now? Why do we have kind of a tepid buying?
Well, one reason is there's not a lot of sellers. Like we just talked about. That's one. Obviously, if there's no sellers, there's no buyers. But the interest rates are tough. You've got more of the financial institutional guys that their calculations are based on interest rates, partially anyway. It's not as, I would say it's more dependent on interest rates than, say, an owner operator with family money. But they've been buying a lot of the restaurants over the last 10 years. So if they're out of the market, it cuts out half your buyer pool, and it just doesn't work with their formula too well. And a lot of these groups just don't want to buy average businesses anymore. And at the end of the day, most businesses are average businesses. That's the word itself. That's what average means. Not every business is a premium business, but a lot of those types of buyers aren't wanting to take the risk on an average business because a downturn, it hurts you, especially if you're already paying 8-9% interest rate.
I think that's a big point, don't you, Peter? That like in the good old days, you'd expect a great business to get 7 or 8 offers on it, and a great business is now getting 4 to 6 offers. So not materially different, a little bit less, but like a mediocre business used to have 3 or 4 buyers for it, and now it has 1. You know what I mean, or 0 maybe. So that's been a pronounced change in the last couple of years. What else do you say, Peter? Got any other ideas?
Well, there's a multitude of things. I think y'all hit on the main one, on the borrowing costs being high, and just when it's a less desirable business with low EBITDA margins, having to deal with, leverage covenants with the banks, they're just not willing to take on the risk. Sales and trans are kind of all over the place over the past, year and a half. And so just, some brands are killing it, and some operators in certain brands are killing it. But, not knowing what it's going to look like in the future just causes some problems. And then I think another one is, some just may have been approved 2 or 3 years ago, but with this downturn over the past year and a half, 2 years, they might not be as approved by the brand or by their lenders. If they're borderline, and maybe can take on another transaction, another deal, they're choosing not to because they'd rather focus on their organization, iron out any internal issues, and try to establish a more healthy business for themselves, so that when they are ready, they're prepared for it.
That's a good point. I mean, some of our deals, we've had franchisors stand in the way and say, we're not going to approve that. They're not approved. They're not approved. There's been a lot more of that than there has been in past years, which leads me to another question about, or comment about the franchisors. A lot of them, some of them are becoming more reasonable. Some of them are becoming more unreasonable, and some of them are about like they always have been. But some of the ones that have become more unreasonable are asking a lot more in the transactions, whether it be a relationship agreement, personal guarantees, or what, like the way you can buy and sell the assets, the way that you have to structure financial covenants. Some franchisors are getting harder, and it's not just that the existing franchisees are in a state of affairs where their businesses aren't strong enough to acquire more stores. It's that the franchisor is putting a collar on who can buy a little bit by making it so restrictive in some cases. So that's a comment too for certain brands, not all brands. And I think I want to make one comment. We'll move on to the next question, which is about private equity groups not being involved in the market so much. And it's very true. It's very much a crickets kind of thing. Like you look around, it's like, man, where am I? I'm in the dark here. Where are the private equity buyers calling? And, they're all gone. And I think they look at multiple uninvested capital, MOIC. That is dependent upon a couple of things. Like they want to buy a business at low interest rate that has high growing sales and where you can build new locations, because the new unit development is a huge piece of the way they get their MOIC calculation higher. Well, in this market, we have this little quiet thing called inflation that has caused the building of new stores to be kind of crazy expensive now. And that alone has been like crumbled this MOIC calculation for these private equity groups in our space, which is one of the unseen reasons why they backed away from a lot of restaurant deals at the moment.
Do you think there will be fewer distressed operators in the future due to interest rates and required refis and balloon payments? Will there be a triggering event? Yeah, I mean, we did some refinancings during COVID, fixed rate 5-year, some 2.5%. As those start to expire and you've got to refi at potentially say 7.5 to 8.5, depending on where rates end up being. I mean, that's a massive, obviously when we're selling companies, we're looking at EBITDA. We aren't looking at the interest people are paying on their loans, but when they're looking at it and they're looking at their year-end review and what they're going to have to be paying and what their net income is going to be and all that stuff, obviously an operator is looking at that very intently. And if you have to pay an extra 6% in interest going forward, even on a potentially smaller loan, that impacts your bottom line quite a bit. And that might impact some franchisees' decisions to stay in the business or not. Regardless of all these other items, if their net income potentially gets cut in half because their interest increases, they might just say, you know what, it's not worth continuing here. So
I think there's going to be a too big to fail scenario though, Derek. I mean, this is just one man's opinion. Too many people refinanced at 2.5 to 3.5% interest rates. And then these balloon payments are going to all come due in like 18 to 36 months from now. And it's going to be it's going to be, it's just going to be too
I'm not saying people are going to fail, but I think it will trigger, to answer a couple of the specific questions, I think it will trigger some people to sell because the ongoing operations just might not be worth it anymore. That's it. It doesn't mean they're necessarily going to go bankrupt, but obviously time value of money, if you're 65 years old and you're making $1 million and suddenly because your interest increases so much, you're making $500,000 or $600,000, maybe you decide, now is the time to sell. It was worth working hard for $1 million a year. It's not worth working hard for $500,000 a year. That's my perspective. I don't think it's necessarily going to bankrupt a ton of people. It could bankrupt some. Don't get me wrong, but it's not going to be a mass bankruptcy event or anything like that. But I think it could trigger some M&A.
Well, I think it could too. You're very right. Like especially if you're like kind of like a mid-tier operator with a small loan to a bank and a bank doesn't care about you and your loan's coming up due, you would sell, right? And you're not going to have the benefit of being like one of the $50 million Taco Bell loans that Bank XYZ holds, and all of them come due in the next 36 months. I mean, that kind of a scenario, if you're a borrower like that, I'm guessing, going to have some leverage because this bank is not going to be able to just kind of all of a sudden default every single one of their enormous Taco Bell loans, right? That's just not going to happen. So, but I think if you're a 20-unit operator who's borrowed $10 million from XYZ Bank in Nebraska, and then all of a sudden your 5-year term loan is up, that is a situation where you probably have less negotiating power, right? Or if you're with a high regional bank and you're one of only a few of their loans. So, I mean, I don't know. But Derek's right. I do think it'll trigger some M&A just from people who aren't over leveraged, but just say, I don't want to work for this little money anymore. What do we think about sales and transactions in our business right now, just across our clients that we're seeing? Comments, guys, from the deals we're doing?
Peter? Yeah, I wouldn't say exactly great right now. A lot of big time value wars out there. You see it all over, pricing on the news and commercials, but obviously everyone is fighting for transactions, which is a kind of a direct correlation to where our customers are right now. If it's going to cost somebody $12, $15 for a meal just for themselves, they've been hit hard over the past couple of years and with extremely high inflation. I think it goes back to one of my earlier comments about, making sure your operations are in line and trying to create as much value for the customer. You can build as many stores if you want to, and you can buy as many stores if you want to, but if your current operators aren't aligned, how much more value you're really creating for yourself? And so really need to focus on, your sales and your because they're struggling right now.
Part of Peter's comment, and obviously we are not restaurant operators, but trust Peter has been actually at one point. We understand how difficult it is. We're not ignorant to that with all the clients we have and all the things that we hear from them and how difficult it's been, not to mention the past 4 years since COVID. So, but I was just thinking, from a personal perspective, what would I want if I am a customer that's feeling squeezed, that already has very little disposable income, and now my favorite QSR food is potentially 30, 40, 50% more expensive than it was a few years ago. What would I want to know, or why would I continue going there? If I thought there was a 50-50 shot that the service would be not great, or my food would be cold or messed up, or the operations weren't in line, if it was dirty, I'd probably rethink going to that restaurant. But if I knew I was going to have a good experience, I would probably be more likely to go. But I don't want to overspend if I'm already tight and have a bad experience. So that's just a general comment. We want to see our clients continue to have good sales and trans and all that stuff. But I was just trying to put myself in the shoes of one of your core customers. I think that's something to don't stray from. Obviously, everyone wants good operations, but it might be more important now than ever.
Yeah, I think that's a great point. And you see it in the P&Ls that we see, right? The good operators, the ones we know who are the good operators who have the strong volumes, you can see that their margins are really strong. And it's likely because they're providing a good customer experience. People have a lot of choice and there are fewer customers and fewer transactions going on now because of the times we're in, right? So we see the good operators doing well, and then we see the ones that are not good operators are really doing poorly. So they're losing probably an outsized number of transactions because of what Derek is talking about. The other thing, and this isn't just Rick Ormsby's swag, okay? So I'm swagging that we have 10 to 15% too many franchise restaurants in our country right now. That's just a Rick Ormsby swag. There are way too many restaurants for the amount of transactions and consumers we have. I mean, every deal, all these 30 deals that we've turned down so far this year. And I hope you respect that about us, because I mean, we're not, the way we work is, for any of you who know us, is like, we're going to tell you what we really think. And if you don't like to hear it, God bless you. But we're not going to get involved in a deal that we don't think is reasonable. But like, as I think about just the overbuilding of restaurants, I think that's going to have every single one of the 30 deals we've seen has like 10% of the stores probably need to be closed. And then we're starting to suggest this pretty strongly to our clients to look at it, because people don't want to buy restaurants that are break even or losing money. What do you think? Let's
franchisors aren't going to like that, but unfortunately, that's just going to have to be reality for a little while. A lot of brands need to see a lot of closures in order to heal themselves and to get better. Just franchisees that are a little healthier, but franchisors aren't going to like that over the next couple of years. But it has to happen, I think.
Healthy franchisees, it's good for franchisors as well. So yeah, completely agree with that.
Well, let's talk about another. What have we seen in deal flow in 2024? I think we've kind of hit, this one, haven't we? I think
we're going to end up closing. I think we're going to end up technically probably closing more deals than we did last year, but a lot of the deals we have have been since last year, essentially deals that have dragged on longer than normal for various reasons. But of the deals that we currently have, they all look like they're scheduled to close here in the next 2 months, knock on wood. But some of them have just stemmed from 2023 and just taken on quite a bit longer to close. But not sure what the first half of 2025 is going to bring in terms of closings.
Yeah, we haven't taken a new assignment probably in 120 days, would you say?
No, we have a couple. We've had 2 deals in the last couple months, one of which will go to market here in the next few weeks, one of which was a quiet off-market process. But in terms of large marketing efforts, yeah, it's been quiet. We've asked around. It's not just us, which I guess makes us feel good. It makes, at least we're not the only ones, but lenders are telling us they're not seeing anything. And, I kind of warn people because of what we're seeing and the deals that we're turning down. And it doesn't necessarily mean they're bad deals. It's just inflated expectations. And a lot of those expectations are due to the high prices of the past few years that just aren't there anymore. And it takes a while for franchisees to accept that they may have missed that. But at the end of the day, it's what it is. So I tell you, if you're seeing a bunch of deals being marketed by someone, and I'm not calling anyone out, I'm just saying it, be careful what you're looking at. Because I would be surprised if we are the anomaly and everybody that calls us is has inflated expectations, but other people are out there with 10 deals with reasonable sellers. So
and I'm always the counter-cyclical guy, right? I'm always thinking about what is it that I'm doing that no one else is doing. So if I'm someone who owns a business and has thought about selling, got a really good business. We said this at the beginning of the webinar here, a really good business that would attract a lot of interest in the marketplace doesn't have any competition. Like, you know what I mean? It has no competition for other competing deals. It would just sit out there in a field. It would be like a dead buffalo with a million vultures coming on it. You know what I mean? So that is a positive element that you might be thinking if you are a would-be seller. Obviously, we have to dig into the actual numbers because that's only one component, but I think that might keep your EBITDA multiple from dropping a little bit more than it otherwise would because of the supply-demand imbalance right now. What do we think will happen for the rest of 2024? Hard to tell. As you just heard from us, it's really slow right now. There's no compelling reason in, I think, any of our minds that it's going to improve tomorrow, like we're all going to roll out of bed and the phone's going to ring with clients who have great businesses and want to sell at reasonable prices relative to what the market is currently providing. I don't think that's the case. Our calls have been increasing a little bit, and there certainly is this element of a pent-up demand building. I always tell people, like, only 25% of the business that, 25% of the business that we do has no correlation with timing, right? Like, people who sell something, 75% of them are selling it because it's really good and they want to make a big profit, or it's really bad and they want to, jump out of it. But there's just 25% of just people who are like getting older in age or have health situations that come up that they don't expect, or there's a divorce, or there's a death in the family, or partners that have a split. Those kind of things just happen naturally kind of over the course of 20 years. And that business, it will continue to be there, but the pent-up demand is building for sure. And at some point, it's got to pop. Maybe it's 12 to 18 months from now. Conditions need to be a little bit better. Consumer needs to be a little bit stronger so that EBITDA is up. But, if it is 18 months from now, that'll be a full, 5 years from our big 2021 where we had just a monstrous amount of deal flow. And the pent-up demand at that point is going to be enormous, I would think. Any comments on what you guys expect for the rest of the year?
I would just say the only thing really to add to that would be, if a seller does decide it's time, there will be buyers out there. It's to build a location right now is extremely expensive, and you can most likely buy a location for cheaper than that. So just a reminder that if there are sellers out there, that there are buyers still.
Couple of questions. Derek, you see this? What would a good EBITDA be? We typically look at things in terms of EBITDA numbers. So like if you're talking about EBITDA in like in a business, we probably would say a baseline of 20% EBITDA margins, pre-G&A EBITDA margins. Some businesses are down in the mid-teens, some in the low teens, and some are as high as the mid-20s. 20% is probably where we draw the line of being a decent business. And then, and if it trails below 15%, it's like, yikes. because when you're talking about EBITDA, that's before G&A, it's before paying your bank loans, and it's also before rent. So below than 15% or 14%, you're probably not, the business, the franchisee's not making any money at the bottom line.
When it comes to, I think 10%, anything sub 8% on a post G&A basis gets tougher.
EBITDA.
Yeah, talking about post G&A EBITDA, specific to that question, because obviously if you've got a 15% EBITDA or Wingstop business, which probably doesn't, their numbers are better than that, but they're paying 3% rent, it might be equal. But you want to see ideally double-digit EBITDA on a post G&A basis. Anything below 8 is going to be tougher. It's just a lot less downside protection, really, in the event of some sales drops. One of the questions here, I don't think we really have an answer. Paradigm shift amongst essentially consumers, boomers move to retirement, Hispanics become more consuming based. Personally, I haven't done any research on that sort of thing, and I'm not gonna act like I know what the answer is.
I don't have the answer either. Although I had seen trends. Hispanic population is now projected to be pretty soon 20% of our country's population, I believe, which is a big shift. A similar question has been asked, like, what is like Wegovy and some of these, kind of inhibitor drugs that help you lose weight. What is that going to do to our industry? Similar type of thing, right? And when I heard that for the first time, like a year ago, I laughed about it. Like, yeah, right. The person who's going to be on those types of medications, they're not going to be on those medications and eating, Wendy's or whatever brand would be, any QSR. But I think I was wrong about that. I think there's going to be some correlation of some kind. People eating less fast food and getting on the weight management stuff. So I don't know. Hard to tell, but it probably will have an impact.
It's not just less fast food. It's just less eating in general. Yeah.
Less eating. I'll make one comment about demand, or supply. And this is a political comment. And look, you probably can hear, I'm not very political. I have opinions, but this isn't a political comment other than just like how it helps your business and demand and supply. If Biden is reelected and the tax cuts expire, you're going to see, like higher or reversion to higher ordinary income tax rates. I think someone tell me here on this call, but I think they're 37% is the top rate now. It'll go to 39.6, right? If the cuts don't get extended or the expiration doesn't get extended. And then, Biden's in the news talking about, capital gains tax increases. He tried to get it passed in 2021. And remember Joe Manchin and then the lady out in Arizona blocked it and he couldn't get it done. But that was probably a third of the push in M&A volume in 2021, people thinking taxes were going to go up. So if like the conditions present themselves after November to where, taxes will go up, I do think you'll see that. That's a very powerful reason why people sell things. Way underestimated reason why people sell things. So that could be the genesis of a kick of business. Just a comment. But how about the next question? Limitations on today's valuations. Let's talk about that for a second. So if you guys are valuing a restaurant business, a non-restaurant franchise business, what do you say? What are the limitations on today's valuations that may not have been here years ago or months ago?
I guess I'll start. Sellers generally, in terms of add backs and pro formas and things like that, if there's reasonable items in there, if you had a store shut down for 6 months and it's fully reopened, we're going to pro forma that store to a full year. That sort of thing, buyers understand and will generally give you the add back. But if we get a lot of people calling us saying, we're not operating these particular stores very well and the buyer is going to be able to do this, and this. Buyers don't buy that. Banks won't buy it. You won't get paid on it. And we won't account for it. We can talk with buyers and tell them what the potential opportunity is, but there are no buyers out there hardly that are actually going to pay you on that. Their response is, if you think there's improvements, then go make them and then take it back to market with better EBITDA. Look at a lot of sellers calling us thinking buyers can run stores for crazy low G&A amounts. We might have a client running 6% G&A and they say, well, a buyer can do it for 2.5%. Well, once again, buyer is going to want at least what a market G&A rate's going to be, whether that's a percentage of sales, whether that's just a fixed number. It just depends on the brand, how hard it is to operate from an above store level, how much more personnel you might need. And the large guys are just going to get a little arbitrage usually. They're going to need a lot less G&A than someone entering a brand. But coming and trying to throw out $25K a store, for example, for G&A, it ain't going to work. No buyer's going to pay you on that.
That seems to be one that we hear more and more in this market. Maybe it's people trying to squeeze to get their EBITDA higher, to get a higher price because their EBITDA is down or multiples down. But it seems like every deal we're fighting with our sellers about the G&A allocation, and every one of them is like 2.5%, and we're saying no every single time. And it's like, and they want 2.5% on $1.2 million or $1.1 million AUV. I mean, like, no one is going to sign up for that. Maybe somebody used to, you know what I mean? But it's an unreasonable ask in this marketplace where the demand's not there. Sorry to interrupt you there. What about
with higher AUVs? If you got $2 million stores, 2.5% might work. There are people out there that use the 50K. It depends. Again, every buyer is going to look at G&A differently. But what we try not to do is lead with a materially unreasonable number. What that does, if you're a seller listening, what that does is it just turns buyers off. If you lead and one of the first things they see is something that they deem very unreasonable, they're going to assume the rest of the transaction is unreasonable. And when they assume that, then it becomes a fight the rest of the way. So just keep that in mind. You don't want to just be seen as blatantly unreasonable at the start, because you're going to turn off a lot of buyers that might have been good buyers. And they just say, you know what, we don't want to waste our time with the deal. We see that quite a bit. So one thing I just recommend is, as hard as it might be, trust your advisor, whether that's us or somebody else. If they tell you something, it's what they do all day, every day. We don't operate restaurants. We don't have an HR team. We don't do all the things that you restaurant operators do on a daily basis. All we do is sell restaurant businesses. So trust us when we tell you how buyers are going to view something.
Yeah, and it really is best to kind of look at it on a per store basis. You can use a percentage all you want, but like Derek mentioned a while ago, if it's a 1.2 AUV versus a 2 million AUV, well, those aren't apples to apples. I mean, I feel like we have seen some sellers push for 55 and 60, not sellers, buyers push for 55 to 60 per location, but that's unreasonable as well, I believe. But the 25 to 30K is unreasonable on the seller side as well. So, kind of like a 45 to 50 seems more kind of in line, I would say.
But again, higher AUV businesses usually have higher per store G&A because there's just more sales to go around, and people usually use it. If you're operating a $1 million AUV business, you're going to try and minimize your G&A a little bit more just because there's less money to go around. But if you've got a $2.5 million AUV business, you're probably trying to squeeze a little bit less. So it's just a little bit fluid deal to deal. There's no absolute rule. Just kind of finger up.
On to the next point, if we could. Sorry to interrupt you. I want to get through some of these questions. What can operators, franchisees, or would-be sellers do to drive better value in their businesses? And during this example, I'd like to talk about store closures, which I made this big comment earlier that maybe 10 to 15% of the stores across the country need to be closed. And, we did have a deal, and I'll just kind of reiterate it, not talking about the brand or the size count, but we've had a recent deal where we put the business up for sale, had like one, maybe two offers, and then the franchisee took it upon themselves to negotiate about 20% closure of the 20% of the stores. We took it back out to the market, and it was a robust situation with like 6 offers and high prices, and the multiple was way higher. And the franchisee, we believe, will get more money net of the closures than they would have dealing with selling the whole business with 4 stores and not the buyer not being able to get the financing anyway. So anytime you come to us, you're going to see that new approach to us, which is, and like Derek said, franchisors aren't going to like that. But the reality is they're going to have to contend with it because they're getting phone calls from their franchisees saying this store can't make it. I can't make any money on $1 million AUV anymore. This isn't 1998. You know what I mean? So that's one thing that we can do is cull the losers out of your portfolio. Do you take them out before you even call us? But we're happy to help you identify those. That's a way to drive a lot of value if you can get negative EBITDA. And it's not just quantitative EBITDA. If you've got a lot of low value stores in your portfolio, a lot of like if you have 50 locations and 30 of them are basically break even, you think anyone in this market's going to want to buy a business like that? So it's not just the negative EBITDA stores we have to ask about. It's also the ones that are barely breaking even. It's a qualitative, not just a quantitative exercise. What other comments you guys have? Tightening up your management, negotiating, remodeling deferrals with the franchisor. What are some other things you might think of to help drive better value for your business?
I'll go back to your comment just a minute ago. It's not just, just to add to that, it's not just the ones that are losing EBITDA right now. What about the ones that are trending negatively over the past 3 to 4 years and you can't seem to fix it? Lease expirations coming up. Maybe try to be proactive. If you've done everything you can to turn that store around, but don't get yourself in a bind and sign another 10-year extension when the next year might come down some more. Be proactive about looking at not just the ones that are losing money, but the ones that are trending down big time.
I think driving better value too. If you think about what you can do to drive the value, I would say make sure you find a good attorney, because now that the deals have gotten more arduous, especially the purchase agreement negotiations, the lease transfers, franchisor stuff, all the due diligence, a lot of attorneys that are in this space may not have adjusted to the greater difficulty in negotiating now. Buyers have more negotiating position than they used to because there aren't as many sellers around. And so their terms are in many cases outrageous, but in a lot of cases less agreeable than they were 3 years ago. So if you have an attorney that is going to hold the line like they did in 2021 on a lot of the due diligence, you're going to lose your deal or the price is going to get retraded pretty significantly. So please hear this. It is important to find a deal-making attorney, and you need to ask, if you don't talk to us first before you do so, you need to ask them, to talk with the attorney and ask the questions. Are you prepared to be more reasonable than you were in 2021 to help negotiate these deals? Because if you're not, they won't close. Comment? Derek, what do you think about that? You're our resident attorney. Think I'm right?
Yeah, there's just a little bit less leverage on a seller's behalf in today's environment. You got to put up with a little more stuff than you otherwise would like to. And that's just the way it is if you want to sell your business today. Buyers are not so aggressive that they aren't willing to just potentially walk away if the deal no longer suits them. So it's unfortunate. That's just where it is. That dichotomy will eventually shift, and sellers should remember it when it does. But that's just kind of how it is today.
It's like a darn ship in the sea. It's rocking back and forth, baby. Right now, we're kind of like bouncing between the valley and the crest of the wave, I guess. Tell me, what about EBITDA? Let's do some of the sexy stuff. EBITDA and multiples. Let's talk about that a little bit. How are these things priced out, and where are they relative to a year ago? That kind of stuff. Comments?
Yeah. So my overall thinking, not having been in this business 20 years, of course, I think a lot of franchisees have a little amnesia from pre-COVID. I think a lot of people do, not just franchisees. I forget what life was like in 2019 almost. But, multiples today, in my opinion, aren't actually that horrible. They just look horrible when you're looking at record highs from late 2020, 2021, early 2022, when you could sell anything for 7 times EBITDA. You could sell below average businesses for record prices back then. And that's just not how it is today. You've still got the Taco Bells and the Wingstops going for strong prices. I would say generally even those multiples over the last 12 months have probably still fallen a little bit, but they're still selling. There's a huge amount of demand for those deals. You've still got Wendy's that's kind of like below them, that's still trading at pretty strong prices. If it's a premium Wendy's deal, I think of an average to below average Wendy's deal is going to be a lower multiple than people think. And then you've just got a lot of other regular tier 1, tier 2 brands, that are probably in the 4.5 to 5 range. And if you're just an average business within those, 5 is probably your peak. If you're a premium business within those brands, maybe you can touch 6. Maybe it's a 5.5, 5.75, maybe 6. But again, it's going to depend pretty specifically on the business within those brands. If you've got 20 stores, I'll give you an example. If you've got 30 stores and all 30 of them are doing great, you're probably going to do pretty well and attract some buyers. If you've got 30 stores and you've got 10 premium locations, you've got 10 absolute dogs and 10 average stores, it's going to be a tough sell, to be perfectly honest with you. You've got buyers that aren't going to want to mess with those other 20. They're going to look at their time value of money and they're going to say, well, we're essentially buying a 10-unit deal here, not a 30-unit deal. So I would say generally across the board, if you looked at an average, multiples today are a full turn and a half less than they were 2 years ago. In certain situations, I think they're even more than that. In certain situations, it might be a little bit less. But I think it's at least a turn and a half lower than a couple of years ago. And over a 10-year average, it's not really that bad. People have just forgot how it was pre-COVID. And 5.5 was considered oftentimes a pretty decent multiple. Now people scoff at it. So
Absolutely. Those good thoughts. I want to answer a couple questions. So yeah, I agree with you. I was going to put the staple in the paper saying about a 1 turn drop in EBITDA multiple. Maybe it's more than that. Derek's at a point, 1.5, maybe more, maybe less, obviously, for brands like Wingstop, Taco Bell, and some of the big movers that are still selling for big prices. Here, a couple questions. Do personal guarantees impact PE's ability to buy portfolios? Franchisors waive personal guarantee for a buyer like that? The answer is basically a resounding no. That's why almost no private equity groups actually buy restaurant assets. And that's why you got to ask that question at the beginning of every process, because they're not aware of how restrictive the guarantee is and the non-compete agreement. So the person asking this question, if you're a private equity guy, you think you're going to, set up some sort of non-compete, non-personal guarantee, no restrictions on buying other assets, I would say good luck to you. Don't make that assumption. All things being equal, the relative.
And it depends on the brand. Some brands are going to be more stringent than others, but we have seen plenty of deals die where we're told we're willing to do this or we can negotiate out of it. And then, of course, they don't. So we are very, very in tune to that on current deals. And if we're being told that by a financial sponsor that they'll negotiate out of it, it's a massive red flag to us that they don't know what they're really in for.
And I don't want to cut you off, Peter, but I think that's a comment for private equity people that are listening here. Number one, the joke's out. Everyone now knows that you guys are mostly out of the market. And they also know that a lot of your deals that you can lock up over the last 6 to 12 months, you're walking away from. So if you're a private equity buyer, you need to counteract that. You need to have your powers, your Superman powers in the other direction. And you need to say, okay, I do know what the requirement is at the corporation, at the franchisor, and I am willing to do it. And here's what it is. That's one side of it. And then the other is like, I'm willing to give you assurances that I'm going to close this deal with you because I know, whatever those assurances are to bolster your confidence. And I'm willing to be more reasonable than maybe some of the prior deals. And the other thing is, and this is Old Man Rick. You ready for Old Man Rick's commentary? Old Man Rick is that there is a increasing amount of morality concern, integrity concerns in this business. And I would challenge all of you who listen to this, and I'm talking to myself. I see myself in this mirror here as I'm looking at myself talking on Zoom. So this is for me too, and for both of you gentlemen. Your reputation, your character, your integrity, and what you say is like really all you have at the end of the day, isn't it? When things get difficult, when you get into a deal where you made a promise to somebody and then it changes, you just see people's mettle getting tested during somewhat difficult M&A environments. And I've seen a massive uptick in lack of integrity. And so don't be that man or woman. Like, make your word your bond. It's not worth it to go back on what you said or to say, I didn't see that, or try to say that you looked right through something and then change the terms or the price for no good reason. It's not worth it. You do it once, everyone finds out about it. Ouch, huh? And I'm mindful of that myself. I try to make my word my bond. People, I try, whatever I say, I try to live up to, do my best to live up to it to great odds, great lengths. And I hope you guys can do that too.
We've talked a lot about the lending market here as well. Yeah. And there's one question we get constantly, and it's seller financing. What I think we said in our January webinar that we thought that seller financing would see quite a bit of an uptick. It hasn't. We're not seeing it at all. I think this is what it comes down to. Franchisees, especially our typical clients that are just long-term, decades-long franchisees, haven't really had a boss. They would rather not sell their business for the most part. Obviously, exceptions exist. Most of these people would rather not sell their business than risk their retirement with some new operator. They will trust themselves to continue the operations and hold on until they don't have to offer seller financing, rather than trusting some random person buying their business that they don't know. Not saying that random person's bad, but they just don't know them most of the time. And when you're selling fully out, it at the end of the day doesn't really matter. You want to sell and you want someone to take care of your business. But when you're taking on seller financing, it's extremely important who's buying your business. And these long-term sellers, they'd rather just write it down and trust themselves rather than trusting someone they don't know. Because at the end of the day, seller financing, it's going to be subordinate to the bank notes. It's not like they have first lien on anything. So there's risk there, and they're just not willing to do it. So my current viewpoint is seller financing is never going to be a huge thing unless the world is like quite literally ending. And even at that point, I could see sellers just writing it down before they trust someone else with their business and essentially their retirement income.
Not always the case if they're forced to be that way, but you're right. It is a shock. It is kind of a surprising conclusion that we're not seeing much seller financing. I mean, for sure. What do you say, Peter? You haven't chimed in in a while. Got any comments? Anything you've heard?
No, agree. Seller financing gets brought up on just about every single deal from a number of buyers. But you also got to think a lot of our clients, like Derek mentioned, this they've been doing their whole life. A lot of their net worth is tied into this. So their purpose of retiring is to take all the eggs out of the basket and just retire and not have to worry about running the business anymore. But they can't do that when they have a note and they can't control the operation of the business anymore. So, seller financing just really isn't an option that we've seen.
Yeah. Well, good. One quick question was, we do take into impact the remodeling costs in the comment. This is just a comment in the question. Remodeling costs are factored in. Typically, our model says something like by brand, it changes by brand, but we're going to take a portion of the next 2 to 3 to 4 years to maybe even 5 years, depending on the brand, of future remodeling expenses, and take a portion of that against the valuation that we come up with. And that neutralizes the difference between a brand new store doing $2 million in sales and a 40-year-old store that needs a remodel doing $2 million in sales.
And it kind of depends. If you've got a brand that can demonstrate some great ROI on a remodel, then it's going to look a little bit better and you can argue for a little bit less of a deduction. If you've got a brand that's got a 25% ROI track record on a remodel versus a brand with a 0% ROI, it's a little bit easier to negotiate a lower discount to the price on that 25% ROI brand. But at the end of the day, it's kind of hard to prove that. It's going to be store specific, but usually we look out a few years and cut it in half. Just as a swag number, that's usually what it is. Every buyer looks at it slightly different. But you can't talk about it. You can't just assume it's zero.
Last question. Good answer. Great answer. Last question for you guys, and then we'll end up here. But it's a good one. So hang on here if you're listening. Why would you sell now? Why would you sell now? Why, if you're an operator, why would you sell now? There's a good portion of people listening who are operators. Why would they sell now?
Well, I mean, we've touched on it, but while multiples aren't exactly where they were a few years ago, historically speaking, over the past 10 to 15 years, they're still similar to the average. Commodity prices have eased over the past year, so EBITDA should be improving if sales and trans are in line or flat or above. However, for the most part, it's not always the case with the sales and trans right now. But what does the future look like? Do we expect it to get better? I really don't know. I don't think anybody knows. I think that's why we are discussing this right now. And then you got to take into consideration the uncertainty of the election. And sooner rather than later, could be your best option. But, it's just my opinion.
You got one, Derek? Yeah. Thank you, Peter.
I think it's uncertainty. I mean, if you truly firmly believe the future is brighter, then hold on. Wait for that. You're going to probably experience some bumps in the road before that happens, is my guess. But go ahead and hold on. I often tell people there's got to be another reason outside of pure financial reasons that people sell. Often it doesn't necessarily make financial sense to sell your company and retire and have to live on the future investments of your proceeds. It often doesn't make sense. There's got to be some other triggering event. Sometimes that could be a death, divorce, health issue. You just simply want to retire and you're comfortable with where you are in life. But that triggering event could also be you're terrified of the future and you don't know what it holds. We could be looking back in a year and say, wow, those 5 to 5.5 times multiples we were talking about last July sure sound nice. You never know. You know where we are today. You don't know where it is in the future. If you feel good about the future, then hold on. If you feel a little worried about the future, it's probably worth at least exploring your options and seeing what kind of value you could get.
Yeah, if there's a trade, that's great. So certainty. And then I would only add to that to just watch the tax considerations. Okay. That taxes are definitely a triggering event for someone who might decide to sell something within 2 years or 3 years or 1 year or 2 years or 0 year or 1 year. You would look at the tax maneuverings. The taxes are set to increase and increase substantially. Oftentimes you do the calculus and you might have been better selling now than you were selling next year because you give it all back in taxes. These are some things to talk with your professionals about. So that's it in closing this time. We really appreciate you guys listening and watching. Hopefully it's been insightful. We hope that the deal flow environment will pick up. You'll see Unbridled. I'm going to be a guest speaker at the Restaurant Finance and Development Conference in a couple of months. So excited for that. So please come out for that. And we'll see you at some of these brand conventions. And we'll all just keep keeping the faith. If you have any questions about valuation or anything specific that we've said, feel free to reach out to us anytime. And Derek and Peter wanted to thank both of you guys for your time. Appreciate it, everybody.
Thanks, guys.
Thanks so much for entering the Boiler Room today. You can find our podcasts on iTunes, Google Play, Stitcher, TuneIn, and Spotify. If you like these podcasts, please listen, rate, and review. I also encourage you to visit our website at www.unbridledcapital.com for the best franchise M&A and financial resources in the industry. Our website includes webinars, podcasts, videos, white papers, and a list of our past M&A transactions. Please note that neither Rick Ormsby nor Unbridled Capital Advisors LLC give legal, financial, or tax advice. These podcasts represent opinions that have been prepared for informational purposes only. We expressly disclaim any and all liabilities that may be based on such information, errors therein, or omissions therefrom.